Imagine running a massive, complex enterprise. You've got millions of stakeholders who are completely relying on you for basic infrastructure, security, healthcare.
Hmm.
Now imagine opening your ledgers for the fiscal year and realizing that before you can allocate a single dollar to, like, operations or maintenance or growth, 89% of your total net revenue is just instantly swept away to service past debt.
Yeah, it's just gone.
Exactly. That leaves you with, what, 11 cents on the dollar to run the entire machine? I mean, in the corporate world, that is terminal.
Right. The board dissolves the company, you liquidate the assets, and everyone goes home.
Right. But what happens when that enterprise is a sovereign nation with nuclear weapons and 240 million citizens?
That changes the math entirely.
It really does. Because in fiscal year 2025, Pakistan spent 89% of its entire net federal revenue on debt service alone. 9 out of every 10 rupees collected were just gone before a single public school or hospital could even be funded.
It is a staggering reality.
Yeah.
I mean, when a sovereign entity reaches an 89% debt service to revenue ratio,
Yeah.
it has basically crossed into a mathematical trap that you just cannot solve
Yeah.
through domestic taxation or, standard austerity.
Yeah.
The state is effectively just acting as a collection agency for its creditors. And the reason we are doing this deep dive today is that Pakistan is, well, it's not an anomaly.
Right.
According to the March 2026 OECD Global Debt Report, central government debt for emerging market and developing economies, or EMDEs, has surged to roughly $14 trillion.
14 trillion?
Yeah, $14 trillion. That represents 30% of their combined GDP, which is a
Okay.
peak we haven't seen since 2007, literally right before the global financial crisis.
And that $14 trillion figure, that's really the premise of our exploration today.
We're looking at a system that appears to be approaching a structural breaking point.
And it's crucial to state up front for you, the listener, that while the source documents we are analyzing deal with political decisions made by various leaders, across the entire political spectrum, our analysis here is entirely nonpartisan.
Right. We are solely concerned with the macroeconomic mechanics.
Exactly. We're just looking at the underlying arithmetic of global debt. Because the prevailing narrative often treats these crises as, like, isolated failures of specific administrations, whether left-wing or right-wing, but the data points toward a profound, interconnected fragility in the whole global financial architecture.
Yeah, and that fragility is most evident in how that debt is actually being managed right now. Like, that same OECD report projects that governments and corporations worldwide will borrow a record $29 trillion from bond market in 2026.
$29 trillion in a single year.
In a single year. And a vast majority of that $29 trillion is not being deployed into capital expenditures.
So it's not building anything new.
Right. It's not building ports or expanding power grids or, funding technological research. It is being issued strictly to refinance old debt.
Wow.
The global economy is basically relying on this unprecedented volume of new borrowing simply to prevent the existing stock of debt from detonating.
Which brings us to the specific focus of this deep dive. The source documents, which are compiled from the IMF, Fitch Ratings, the OECD, and independent economic institutes, they've identified 5 specific countries that have moved way beyond theoretical vulnerability.
Yeah, they are right on the edge.
Tunisia, Bolivia, Gabon, Kenya, and Pakistan. These 5 are currently exhibiting the metrics of near certain default within a 24-month window.
Yeah, and to understand why these specific 5 are flashing red, we really need to first define the mechanics of a sovereign default.
Right, because it doesn't just happen out of nowhere.
No, not at all. It is rarely a sudden shock. A state doesn't just wake up one morning and decide, hey, we're no longer going to honor our bonds. It is a highly predictable mechanical deterioration that occurs across 5 distinct stages.
So let's map out that progression. What's the very first domino to fall in the sequence of a sovereign debt crisis?
So, stage 1 is fiscal stress. This happens when a government's debt service obligations structurally exceed its capacity to raise revenue through, sustainable taxation or domestic borrowing.
Okay.
The sovereign yield curve begins to steepen, which basically means investors are demanding higher interest rates for long-term debt, signaling that they're losing faith in the government's future fiscal discipline.
Right. So to put this in relatable personal finance terms, stage 1 is basically living paycheck to paycheck.
That's a great way to put it.
Your operational costs are outstripping your incoming cash flow, but instead of cutting expenses, you're just relying on your existing savings to bridge the gap.
Precisely. And that capital buffer brings us to stage 2, which is the reserve drawdown.
Draining the savings account.
Exactly. When a country operates at a deficit and owes foreign-denominated debt, usually that's in US dollars or euros, it has to pull from its central bank's foreign exchange reserves.
Right.
These reserves are the critical stockpile of foreign currency used to settle international trade, things like importing fuel and medicine, and to defend the value of the domestic currency. So when fiscal stress becomes chronic, the central bank is forced to just drain these reserves to prevent a missed bond payment.
But wait, if the reserves are completely drained, how does a country physically function? Because, I mean, international commodity markets don't accept local depreciated currency for oil shipments, right?
No, they don't. And that is exactly why the exhaustion of reserves triggers stage 3, monetary financing.
The payday loan stage.
Right. Once the hard currency is gone and international capital markets either refuse to lend or they demand just extortionate yields, the government turns inward. The executive branch essentially forces the central bank to print domestic currency to purchase government bonds directly, covering the budget shortfall.
Okay, I want to pause on that mechanism for a second because that sounds like a blatant violation of central bank independence.
Oh, it absolutely is.
If a treasury can just mandate that the central bank conjure money into existence to pay state salaries, I mean, inflation seems completely unavoidable.
It is completely unavoidable. The money supply expands drastically without any corresponding increase in the actual economic output of goods and services. So you have more currency chasing the exact same amount of goods, which destroys the purchasing power of the domestic population.
Wow.
And crucially, printing domestic currency does absolutely nothing to resolve the external debt crisis because foreign creditors still require payment in dollars.
Right.
This internal collapse leads directly to stage 4, which is market exclusion.
This is getting your credit cards canceled.
Yep. It's the point where international investors officially recognize the underlying insolvency. Credit rating agencies downgrade the sovereign to near default status.
So they're completely locked out.
Right. If the country attempts to issue a new bond to raise capital, the market either refuses to buy it, resulting in a failed auction, or they demand an impossibly high yield. The state is locked out of the international financial system.
And once that happens...
Once market exclusion occurs, stage 5 is inevitable. The formal default, total bankruptcy. The state either misses a scheduled coupon payment or publicly declares a moratorium on its debt obligations.
So the sequence, fiscal stress, reserve drawdown, monetary financing, market exclusion, and then default. It's a rigid, repeating pattern.
Very rigid.
And the historical case studies provided in our sources illustrate exactly how destructive this cycle is on a granular level. Like Argentina in 2001 is often cited as the textbook example here.
Yeah. Argentina's 2001 default, which involved over $100 billion, perfectly encapsulates the danger of structural rigidity. For a decade, Argentina operated under the convertibility plan, which pegged the Argentine peso directly to the US dollar at a 1-to-1 ratio.
Which sounds good on paper.
Right. It was initially implemented to kill hyperinflation, but it required the central bank to hold massive US dollar reserves to back literally every peso in circulation.
So when their fiscal deficits began to widen in the late 1990s, they had to borrow heavily in dollars just to maintain that currency peg.
Exactly. And because their economy was locked to the dollar, their exports became globally uncompetitive compared to neighboring countries with floating currencies. So they entered stage 2 massive reserve drawdown, trying to defend the peg, while simultaneously servicing huge IMF loans.
Oh, man.
And when the IMF eventually realized the math was unsolvable and withheld a scheduled disbursement in late 2001, Argentina immediately hit stage 4 and 5. The ensuing crisis was catastrophic.
They had to freeze bank accounts, didn't they?
Yes, the Corralito. The government had to freeze all bank accounts just to prevent a total run on the banking system.
Wow. So if Argentina illustrates the danger of a currency peg, the 1998 Russian financial crisis demonstrates the peril of commodity dependence combined with short-term domestic debt.
Right. Russia's progression was terrifyingly fast. Their fiscal revenues were heavily dependent on energy exports. In 1998, global macroeconomic shocks drove the price of Brent crude oil down to roughly $10 a barrel.
$10 a barrel? That is insane.
Yeah, Russia's tax receipts just evaporated. To plug the hole, they relied heavily on GKOs, which are short-term, zero-coupon government treasury bills.
And relying on short-term debt is incredibly dangerous because you have to constantly roll it over.
Right, yeah.
You're continuously returning to the market every few months, asking for new money to pay off the old money.
And when oil hit $10, investor confidence vanished. The yields on those GPOs spiked to over 200%.
200%.
Yeah. The Russian central bank burned through billions in foreign exchange reserves trying to defend the ruble, but the capital flight was too massive. By August 1998, they shocked the global financial system by declaring the default on their domestic ruble-denominated debt and halting payments to foreign creditors.
Which brings us to a highly contemporary example in the sources, Sri Lanka in 2022. This really demonstrates how rapidly a nation can move from stage 2 to stage 5 when policy errors compound external shocks.
Sri Lanka is really a masterclass in the anatomy of a default. In early 2020, their foreign exchange reserves stood at a relatively healthy $8 billion.
Okay.
But a severe drop in tourism revenue due to global events, combined with massive unfunded tax cuts, just drastically reduced state income. By mid-2021, those reserves had plummeted from $8 billion to $1.6 billion, stage 2 in full effect.
And instead of aggressively restructuring their debt at that point, they engaged in stage 3.
They forced the Central Bank of Sri Lanka to print unprecedented amounts of rupees to finance the widening fiscal deficit. Inflation skyrocketed to over 70%.
That's devastating.
And the daily mechanical reality for the citizens was horrible. Because the central bank had no dollars left to issue letters of credit for importers. Ships carrying fuel and medicine simply sat off the coast, refusing to dock. Citizens waited in lines for days just to buy cooking gas. By April 2022, with essentially zero usable foreign exchange reserves left, the finance ministry announced a preemptive default on all external debt.
Okay, so with those historical precedents establishing the mechanics, we can now examine the real-time data for the 5 nations currently exhibiting these identical symptoms. Let's begin with Tunisia. Because Tunisia is not a case of long-term abstract vulnerability. They are facing an acute chronological deadline.
Yeah, the timeline for Tunisia is exceptionally compressed. At the time the June 2026 data was compiled, Tunisia was literally weeks away from a massive maturity wall. On July 15, 2026, an $826 million Eurobond comes due.
Okay, before we look at their balance sheet, let's define that term for clarity. What differentiates a Eurobond from a standard domestic bond, and why is it so much more dangerous in a fiscal crisis?
So a Eurobond is an international debt instrument that is denominated in a currency not native to the country where it's issued. For emerging markets like Tunisia, these are almost always denominated in US dollars or euros. The critical danger is the currency mismatch. Tunisia collects its tax revenue in Tunisian dinars, but it must pay this $826 million obligation in hard foreign currency.
Ah, I see.
If the dinar depreciates against the dollar or the euro, the real cost of servicing that Eurobond mechanically increases, even if the interest rate is fixed.
So they have an $826 million hard currency obligation due essentially immediately. And when we look at their underlying fiscal health to assess their capacity to make that payment, the metrics are highly distressed.
Very. The headline, public debt to GDP ratio for Tunisia has reached 82.9%. Historically, their debt levels hovered around the low 60s.
That's a huge jump.
And this rapid accumulation of debt is occurring alongside a projected economic growth rate of just 1.9% for 2026. When the cost of carrying your debt expands exponentially faster than your economic output, your fiscal space just vanishes.
And according to Fitch Ratings, that 82.9% figure is only the surface level liability, right? There's a massive contingent liability operating off the books.
Yes. Fitch explicitly flags the debt held by Tunisia's state-owned enterprises, or SOEs. They estimate SOE debt is equivalent to approximately 40% of Tunisia's GDP.
Wait, really? How does an obligation equal to 40% of the entire economic output of a nation remain off the official government ledger?
Well, state-owned enterprises operate as separate legal entities. They're the national utility companies, state airlines, transport logistics firms. They issue their own corporate debt to fund their operations.
Okay.
However, because they are state-owned, the market treats this debt as having an implicit sovereign guarantee. I mean, if the state electricity provider goes bankrupt, the central government cannot simply allow the national power grid to collapse.
Right, they have to step in.
Exactly. They are forced to step in and assume the liabilities. Therefore, the true sovereign debt burden of Tunisia is vastly higher than that official 82.9% metric.
Normally, when a country faces an impending Eurobond maturity, a crushing debt-to-GDP ratio, and stagnant growth, they immediately initiate negotiations with the International Monetary Fund. But the data shows Tunisia is actively avoiding the IMF.
Yeah, and this is where macroeconomic reality collides with domestic politics. Tunisia's president, Kais Saied, has consistently rejected the structural adjustment programs required by the IMF.
Because of the conditionalities.
Right. The IMF mandates conditionalities like cutting public subsidies, restructuring those heavily indebted state-owned enterprises, freezing public sector wages in exchange for emergency liquidity. The Tunisian executive branch views these conditionalities as an unacceptable infringement on national sovereignty and a catalyst for domestic unrest.
But if they're refusing the IMF lifeline and the Eurobond maturity is days away, how is the state financing its daily domestic operations? Because civil servants still require their salaries on the first of the month.
They have fully engaged Stage 3, monetary financing. In 2025, the Tunisian parliament took the extraordinary step of formally authorizing the Central Bank of Tunisia to directly finance the state treasury.
Oh, no.
Yeah. They approved up to 7 billion Tunisian dinars in direct funding at 0% interest.
A parliament explicitly ordering the central bank to print billions of dinars at zero interest seems like a suspension of basic economic gravity. Doesn't the financial market instantly price in the resulting inflation?
It does. What's fascinating here is how this exact behavior perfectly mirrors the late stages of Sri Lanka's 2022 collapse. It is a desperate liquidity maneuver that basically guarantees future insolvency.
Because it's just monetizing the deficit.
Exactly. When a central bank purchases government debt at zero interest, it expands the central bank's balance sheet and floods the domestic banking system with fiat currency that is untethered to any productive economic activity. While it allows the Treasury to clear its domestic payroll for a few months, it accelerates capital flight. And crucially, creating 7 billion dinars out of thin air does not yield a single US dollar to pay the international creditors holding that July 2026 Eurobond. Tunisia is attempting to solve a foreign exchange crisis with a domestic printing press.
So if Tunisia represents the acute crisis of an impending deadline, the data on Bolivia illustrates what happens when a nation simply bleeds out its fundamental reserves over a decade. The Bolivian scenario is a profound structural erosion.
Bolivia is the purest contemporary example of Stage 2, the reserve drawdown. The central metric defining their distress is their foreign exchange position. In 2014, the Bolivian central bank held a very robust $15 billion in foreign exchange reserves.
Okay, 15 million.
Largely accumulated during a global commodities boom. But by December 2024, that figure had plummeted to approximately $50 million.
I mean, a drop from 15 billion to 50 million is a 99.6% collapse. $50 million is like the cash equivalent of a mid-sized corporate treasury.
Yeah.
How does a sovereign nation with 12 million people function internationally with only $50 million in liquidity?
The physical mechanics of operating a state with essentially vault cash are grueling. When a country lacks dollars, the central bank cannot clear international transactions for domestic importers. This creates massive friction in the real economy.
Give me an example.
For example, Bolivia relies heavily on imported refined fuels like diesel. If the central bank cannot provide dollars to the state energy company to pay foreign refineries, the fuel shipments stop. The government is forced to implement rationing, limit dollar withdrawals from domestic banks, and rely on an exploding black market where dollars are traded at massive premiums over the official, overvalued exchange rate.
And the international monetary community is fully aware of this paralysis. The June 2025 IMF country report explicitly categorized Bolivia's sovereign distress risk as definitively high.
The IMF highlighted the lethal combination of an overvalued official exchange rate, which destroys export competitiveness and exhausted reserves. And this is compounded by severe internal fiscal imbalances. Bolivia's general government gross debt reached 93.7% of GDP in 2025, and they're operating with a fiscal deficit exceeding 10%.
A double-digit fiscal deficit means the government spending apparatus is entirely detached from its revenue reality. They are hemorrhaging capital without any mechanism to replenish it.
Which leads directly to the assessment by Oxford Economics in October 2025. Evaluating this data, they assigned Bolivia a baseline default probability of 45%.
Wow. When a major macroeconomic forecasting firm assesses sovereign default as essentially a coin toss, it signals deep institutional rot.
Exactly.
Now, the sources indicate that the executive leadership under new President Rodrigo Paz is attempting to implement reforms. But a shift in policy doesn't instantly repair a hollowed-out central bank.
Right, the Paz administration has recognized the severity of the crisis, but structural reform takes years to yield fiscal results. They managed a slight reduction in the fiscal deficit, moving it from 10% down to 9%.
But didn't they target 7%?
They did. This minimal consolidation completely missed their own stated target of 7%.
And if your foreign exchange reserves are at 50 million, narrowing your deficit by 100 basis points doesn't change the underlying math of your external obligations.
It doesn't. And it's the forward-looking obligations that make Bolivia's position so untenable. While they somehow managed to clear a $388 million debt service payment in April 2026, likely by scraping the absolute bottom of domestic dollar liquidity, the maturity schedule is unforgiving.
What do they owe?
They owe $1.6 billion through the end of 2026 and a total of $12 billion through 2030. There is no mathematical model where a state with $50 million in reserves and a 9% fiscal deficit can service $1.6 billion in near-term external debt.
So, if Bolivia's crisis is driven by the evaporation of reserves, the situation in Gabon illustrates a different catalyst for collapse: a total dependency on a single volatile commodity and the destructive domestic policies enacted when that commodity's value drops.
Gabon's macroeconomic architecture is fundamentally tethered to the global price of oil. Their national budget requires the price of Brent crude oil to remain at or above approximately $85 per barrel just to achieve fiscal neutrality.
When a nation's entire fiscal viability is predicated on a global commodity price over which it exerts zero control, they are entirely exposed to external shocks. If global demand softens, or if non-OPEC production surges and Brent crude drops below that $85 threshold, Gabon's treasury instantly goes into a deficit.
And that deficit rapidly translates into a downgrade of sovereign creditworthiness. In February 2026, Fitch Ratings issued a highly explicit warning regarding Gabon, citing an inherent risk of default. By May of 2026, Fitch affirmed their rating at CCC-. In the credit rating taxonomy, a CCC- rating indicates that default is highly probable and imminent. It is the absolute lowest tier of viability before a state is considered to be actively defaulting.
The downgrade isn't solely based on the price of oil, though. The data shows Gabon is running a 12.2% fiscal deficit, but the mechanism they are using to manage that shortfall is particularly damaging. The sources highlight that a significant portion of this deficit, equivalent to 4.8% of GDP, is financed through the accumulation of arrears.
Yeah, the accumulation of domestic arrears is one of the most toxic indicators of advanced fiscal distress.
Yeah.
It signifies a transition deep into stage 3 and approaching stage 4.
Let's clearly define arrears in this context. In macroeconomic terminology, it sounds almost clinical, but in reality, running up 4.8% of GDP in arrears means the sovereign state is systematically defaulting on its domestic obligations. So, arrears is basically a polite economic term for simply ghosting your contractors and not paying your bills, right? They are contracting private companies to build infrastructure, provide logistics, or supply materials to the government, and when the invoices are submitted, the Treasury simply refuses to process the payments.
That is precisely what it means. It is forced, uncompensated borrowing from the private sector. The state leverages its authority to simply withhold payment for services rendered.
So what happens to a local economy when the government, usually the biggest spender, just stops paying its invoices? If the state systematically ghosts its domestic contractors, what happens to the domestic financial system?
It creates a catastrophic liquidity cascade. When the government refuses to pay a major construction firm, that firm cannot pay its suppliers, it cannot meet its payroll, and most importantly, it cannot service its own commercial loans.
Oh, I see where this is going.
Right. This generates a massive wave of non-performing loans, or NPLs, within the domestic banking sector. The commercial banks are suddenly holding toxic assets, their capital adequacy ratios plummet, and they immediately restrict lending to the broader private economy. The government's decision to utilize arrears effectively suffocates the entire domestic credit market.
And while the domestic economy is being paralyzed by these non-performing loans, the sovereign still carries an immense public debt burden. The projections for 2026 place Gabon's government debt at 80.6% of GDP.
Which connects Gabon directly back to the Russia 1998 historical precedent. This combination of high debt, high deficits, and massive domestic arrears is a textbook stage 3 and 4 situation where investors won't buy their bonds. We see this empirically in the data from Gabon's domestic bond auctions. The bid-to-cover ratios have collapsed below 50%.
For those unfamiliar with auction mechanics, the bid-to-cover ratio is a primary indicator of market confidence. If a treasury goes to the market seeking to issue $100 million in bonds and the market submits $200 million in bids, that is a 2-to-1 ratio. It indicates strong demand.
But a ratio below 50% means that when Gabon's treasury attempts to borrow $100 million, the collective market is only willing to risk $40 or $50 million, regardless of the interest rate offered.
They just don't want it.
Exactly. The market is explicitly refusing to absorb Gabon's debt. This failure of domestic financing forced Gabon to officially request an IMF program in March 2026. Without that external liquidity, the state cannot function.
Okay, so if Gabon's distress is obvious and highly visible through failed bond auctions and domestic arrears, our next country, Kenya, presents a much more sophisticated facade. On paper, Kenya appears to be actively managing its liabilities, but the underlying data reveals a deeply fragile architecture.
Kenya is the prime example of the illusion of debt sustainability. They maintain access to international capital markets, but the internal metrics are highly degraded. A pivotal report published by the Institute of Public Finance in Kenya in January 2025 laid bare the extent of the deterioration.
Right.
The institute verified that Kenya had breached every single debt sustainability threshold established by the IMF.
And the IMF doesn't set these thresholds arbitrarily. They represent the mathematical limits of a state's capacity to service debt without cannibalizing its own economic growth. And Kenya has not just breached one metric, they have crossed all of them. The debt to GDP ratio, the debt service to revenue ratio, and the external debt service to exports ratio.
Yeah, and when a sovereign breaches the debt service to revenue threshold, the mechanical reality inside the national treasury becomes entirely reactive. The treasury managers start every day in a liquidity squeeze.
It's just constant triage.
Exactly. They must constantly prioritize which essential function to delay, whether it is delaying the release of funds to local county governments, freezing new public sector hiring, or delaying payments to the National Health Insurance Fund just to ensure the external debt service clears the central bank.
And as the Institute of Public Finance warned, operating perpetually beyond these thresholds strips the economy of any macroeconomic shock absorbers.
Which is why they are so reliant on the IMF. By July 2025, Kenya's total outstanding obligations to the IMF surpassed $3 billion, making them the third largest IMF debtor on the African continent.
Wow.
But rather than using that liquidity to undergo deep structural consolidation, Kenya has engaged in massive refinancing operations.
Right. The most notable operation occurred in early 2026. Kenya went to the international markets and successfully issued a new $2.25 billion Eurobond. They subsequently utilized the proceeds from this new issuance to execute a buyback of their shorter-term debt obligations that were maturing imminently.
Right, a textbook liability management operation.
But here's where it gets really interesting. They issued debt to pay off debt. I want to challenge the utility of this strategy from a macroeconomic perspective.
Okay.
I understand that in corporate finance, extending your maturity profile is considered sound management. You avoid a near-term default by pushing the repayment date out 5 or 10 years. But sovereign states are not corporations. Does extending the maturity actually solve anything, or are they just hitting the snooze button on a ticking time bomb?
Your skepticism is entirely warranted. While executing a bond buyback averts an immediate Stage 5 default, it is a purely cosmetic fix if the underlying economic fundamentals remain stagnant. Refinancing alters the maturity schedule, but it does not diminish the aggregate stock of debt.
Right.
In fact, because global interest rates have risen significantly, the newly issued $2.25 billion Eurobond almost certainly carries a higher yield than the older debt it replaced. Kenya has essentially purchased time at an exorbitant premium.
So the debt burden has actually become heavier in terms of annual servicing costs, even if the principal repayment is deferred.
Precisely. And this strategy leaves Kenya's fiscal architecture highly exposed. Because they are balancing immense debt loads on incredibly tight revenue margins, any external macroeconomic shock like commodity crisis, global borrowing costs will fracture the system.
They have no buffer.
Exactly. If global borrowing costs increase further, preventing future refinancing, or if a domestic political crisis disrupts tax collection, Kenya has no fiscal buffer to deploy. They are operating in a state of permanent high-wire vulnerability.
Which perfectly transitions us to the final country in our analysis. If Kenya is currently balancing on that high wire, Pakistan is the entity that has fallen off, been caught by a safety net, and climbed back up 25 separate times. Pakistan represents the ultimate endpoint of a broken global debt architecture.
It really does. Pakistan is the ultimate case study in institutional enablement of sovereign debt cycles. Let us revisit the defining metric we established at the beginning. In fiscal year 2025, 89% of net federal revenue was consumed by debt service obligations.
Yeah, when capital allocation reaches that extreme, the state's capacity to govern effectively ceases. It cannot invest in physical infrastructure, human capital, or technological development, and the resulting macroeconomic volatility is extreme.
At every extreme.
The inflation data from the sources is staggering. Pakistan's inflation rate whipped from a low of 0.3% in April 2025 all the way up back to 11.7% by May 2026.
That level of inflation volatility destroys long-term private sector planning and investment, and the burden continues to grow, with gross government debt projected at 71.3% of GDP for 2026. But the critical factor differentiating Pakistan is its profound historical dependency on external bailouts. Since joining the International Monetary Fund in 1950, Pakistan has engaged the IMF for 25 separate bailout programs.
25 distinct interventions by the lender of last resort.
Yeah. As of March 2026, their outstanding obligations to the IMF stood at over 7,138 million SDRs. SDR stands for Special Drawing Rights, which is the IMF's internal unit of account, based on a basket of the world's leading currencies.
This historical record forces a deeper systemic question. If the IMF has bailed a country out 24 times without structural success, at what point does the global financial system bear responsibility for enabling a debt cycle that starves the actual citizens of basic services? I mean, are these bailouts actually designed to rehabilitate the sovereign economy, or are they simply mechanisms to ensure that international commercial creditors are made whole?
That is the central paradox of the current sovereign debt regime. If we connect this to the bigger picture, the data strongly suggests that these repeated IMF interventions primarily serve a defensive function for the global financial system.
Defensive how?
Well, by providing emergency liquidity to Pakistan, the IMF prevents a chaotic, disorderly default that would inflict immediate losses on global commercial banks and bondholders. However, because the bailouts are structured as new loans rather than deep debt forgiveness, they do not alter the fundamental insolvency of the state. They merely extend the timeline, trapping the country in a continuous loop of borrowing just to serve as previous borrowing.
Yeah. So, having examined the localized mechanics of these 5 nations, Tunisia's impending 4-week deadline, Bolivia's empty vault, Gabon's unpaid bills, Kenya's breached thresholds, and Pakistan's permanent bailout loop, we must now zoom out to the macro implications. The source documents project 3 distinct scenarios for how this systemic fragility will unfold over the next 24 months.
Right. The analytical projections map out a baseline scenario, an alternative intervention scenario, and a worst-case contagion event.
Let's start with the baseline.
The baseline, or most likely scenario, dictates that the structural pressures are simply too great to be contained. The data indicates that at least one, and highly likely 2, of these 5 nations will fail to clear a hard currency obligation by the second quarter of 2027.
Based on the immediate chronologies, Tunisia is the most probable candidate for the initial failure due to its July 2026 maturity wall, while Bolivia possesses the deepest structural incapacity due to its lack of reserves, and Gabon is the most exposed to external shocks.
Exactly. Now, the alternative scenario models a continuation of the extend and pretend dynamic. In this path, we see extraordinary 11th-hour interventions. The IMF softens its conditionalities, or bilateral lenders such as the Gulf states inject emergency capital.
Which pushes the problem out to 2027 or 2028.
Yes, but as the Pakistan data proves, this solves nothing structurally. It merely delays the inevitable detonation.
And the third scenario outlined in the sources is the contagion model. This is the worst case that threatens the broader stability of the global financial plumbing.
Contagion is the most severe outcome. In this model, the failure of one sovereign acts as a catalyst for a massive repricing of risk across all emerging markets. If a Tunisia default triggers a repricing of African sovereign risk, institutional investors globally will immediately reassess other highly indebted nations. The market will look at Kenya's breached thresholds and Gabon's arrears and determine that the risk premium is insufficient.
So borrowing costs spike for Kenya and Gabon simultaneously?
Precisely. Even if Kenya or Gabon have made no negative policy decisions that specific week, they are suddenly locked out of the international capital markets simply because the global risk appetite has evaporated. We'd see a repeat of the 1997 Asian financial crisis contagion.
And if that happens, the sources explicitly reference the G20 Common Framework as the restructuring mechanism. They cite Ethiopia's default in December 2023 as precedent. Why is entering the Common Framework considered such a devastating outcome for a sovereign state?
Well, the G20 Common Framework was established to coordinate debt relief between traditional Western creditors, new massive bilateral lenders like China, and private commercial bondholders. But the mechanics of getting all these disparate entities to agree on how much of a loss they must accept on their bonds is excruciatingly slow.
Absolutely.
As the Ethiopian case demonstrates, a sovereign can be trapped in the Common Framework negotiations for 5+ years. During that entire period, the country is in financial purgatory. They cannot access international credit, their domestic economy is subjected to brutal austerity to preserve whatever cash remains, and economic growth is completely paralyzed.
Wow. So this brings us to the ultimate implication of this analysis, the crucial, so what does this all mean? Question. For those listening in advanced developed economies, why should they care? Why does a localized sovereign default in Central Africa or South America matter to someone in the US or Europe?
The relevance is embedded in the initial OECD data we discussed. The global financial system is currently operating as a colossal refinancing engine. 78% of all government borrowing by advanced economies in 2026 is dedicated strictly to rolling over existing debt.
78%.
Yes. The entire architecture is dependent on seamless, continuous liquidity and absolute market confidence. If the refinancing engine stalls for the emerging markets, it's a terrifying signal for the global debt system.
Because it introduces severe friction.
Exactly. The debt of these EMDEs is not held in a vacuum. It is held by global pension funds, major institutional asset managers. A wave of defaults destroys capital on their balance sheets. It disrupts global supply chains that rely on the stability of these emerging economies for raw materials and intermediate manufacturing. When multiple sovereign states transition into default, the resulting volatility inevitably transmits upward into the core of the global financial system.
So just to briefly recap the precipice we're on, we see Tunisia staring down an impossible 4-week deadline without IMF support. We see Bolivia attempting to operate with an empty vault. We see Gabon ghosting its contractors and utilizing domestic arrears. We see Kenya masking its systemic threshold breaches with high-cost refinancing. And we see Pakistan illustrating the terminal failure of the permanent 25 bailout regime.
And the most sobering reality to mull over is that this cascade has already begun. According to the CFR Sovereign Risk Tracker, 3 sovereign states are actively in default as we speak: Belarus, Lebanon, and Venezuela. The threshold has already been breached.
That is chilling.
The real question is no longer if defaults are coming. It's a question of who falls first, and whether the global debt architecture, a system that currently relies on borrowing $29 trillion a year just to keep the lights on, can absorb the shockwave when they do.
Well, that is certainly a provocative thought to leave off on. It fundamentally challenges the assumption that global sovereign debt is a permanently manageable phenomenon. Thank you for joining us on this deep dive into the underlying data. Keep questioning the numbers behind the headlines, and we will see you next time.